Well, good morning and welcome to the Plato Webinar on dividends and retirement income. Where to from here? My name is Mark Cormack and I'm a director with Pinnacle Investment. Pinnacle are equity partners and work alongside Plato to distribute their Australian and global income funds to the financial advisory marketplace. And today I'm delighted to be joined by Plato's founder and managing director, Dr. Don Hampson, and Plato's Senior Portfolio Manager, Dr. Peter Gardner, who will take you through their outlook for retirement income as we look to come out of the COVID-19 world. Just in terms of background, Plato are an independent fund management group that specifically manages equity solutions for low tax investors such as retirees. And it's very different to most fund managers who manage money for clients in all different tax brackets. And because Plato manage their investments specifically for low tax investors, it means that they can invest very differently to deliver a high income solution. Suddenly, portfolio turnover is irrelevant and capital gains tax is no impediment to Plato actively allocating and seeking income opportunities in the market. Plato can be more nimble and active than other fund managers. They can buy and sell businesses with strong balance sheets who have the ability to pay income throughout the calendar year and rotate through different sectors and stocks to deliver a high income solution that meets retirees' drawdown needs. And it's important to note that Plato does this without being permanently overweight banks or other high yield stocks and sectors such as REITs, telcos, or infrastructure stocks. And it's also important to note that Plato does this by being pure long only in its approach. We do not use any options or derivatives to boost income, which can often come at the cost of capital. The outcome has been that the Plato Australian Shares Income Fund has delivered over 9% per annum income since inception. And it's important not just to note about the income, but Plato Australian Shares Income Fund has also outperformed the ASX 200 on a total return basis since inception. And this has been at a time when a lot of traditional big income paying stocks like the banks have struggled over the last couple of years, making these returns even more remarkable. So turning to today's Plato webinar, the presentation should last around 20 to 25 minutes, and all attendees have the opportunity to ask questions via the internet, and this can be done by clicking the questions tab on your screen. That's enough from me. Without further ado, I'll hand you over to the Plato team of Dr. Don Hampson and Peter Gardner for today's presentation. Thanks, guys.
Thank you, Mark, and thank you, listeners, for tuning in this morning. We'll start with the macro outlook, and we've been saying for some years now that interest rates are likely to be lower for longer, and the impact of COVID has just meant even lower for longer. We saw the immediate reaction by the RBA to cut rates twice in March to their current level of 25 basis points. We don't expect, and economists don't expect that to change. Indeed, we expect a prolonged period of interest rates at 25 basis points, which has meant that the returns on cash-like products, term deposits, overnight cash at bank, and even government bonds has fallen to below 1%. So we're seeing some very, very low interest rates. And what that means is that the real rate of return on these so-called safe assets has now fallen into negative territory. And we've updated this chart to the actually end of April, and taking into account the latest inflation numbers, which actually ticked up in March, strangely, although we expect that they may fall a little bit in the June quarter as we see the fall in oil prices coming through on petrol prices. But inflation was actually 2.2% in the year ended March 2020. And when you take that off the nominal yields of overnight cash at 25 basis points, 1 year term deposits, which are now sitting just below 1% according to the RBA, and the 10-year bond rate, we are looking at $1 million basically losing you somewhere between sort of $10,000 and $20,000 a year if you've got your money in those so-called safe assets, because inflation is running larger than that. So it's the case that income is getting extremely hard to find in the current environment. It's also affecting equities, as we'll talk about in a minute. So moving on, I mean, we've always said we thought the economic pain may be worse than the pandemic, particularly for Australia, and we can see that Australia is ahead of the curve. You know, we certainly have seemed to flatten that curve completely, and virtually zero outbreaks in Australia at the moment, the odd little peak, but the economic risk is still there. There's still a large number of unemployment. And you know, the actual risk levels that we've seen already have actually exceeded those in the GFC. So the VIX index, now I know this is a US index, but the US implied volatility index actually hit levels that were marginally higher than the GFC in mid-March. But these have now receded, but still to high levels. So we're still talking volatility levels in the high 20s, which is equivalent to around May 2009 coming out of the GFC. So in the GFC, you had an elevated period of high VIX for something like 18 months. We've only had a couple of months of that now. So, but we do think the economic uncertainty is still there. And that full economic impact is still to come, although it looks like Australia is getting away pretty lightly on that regard. So what does this mean for dividends and what are governments doing and what's happening? I've got a chart here that I think is very insightful. There's a few things happening on this chart, so I need to explain it, but we sourced this from Citi, so Citibank, their FX group actually. Now on this chart, there are 3 different things that are measured. The size of the circle represents the number of cases, and you can see Australia's had a very low level of cases, whether you take it in total terms or as a percentage of the population. You know, we've got away fairly lightly compared to the US and Europe and the UK. The countries are actually, in this case, denominated by their currency. So the US is USD, Australia is the AUD, and so for England is the Great British Pound. The horizontal axis on here actually highlights the amount of fiscal stimulus that governments have announced in the various countries. And you can actually see, but this is a controversial one, of course, that Australia, according to Citi, has got the largest fiscal stimulus announced of any country. Now, obviously, this chart's a few days old, so it was actually before we found out that perhaps the government had overestimated the JobKeeper costs, and that might bring us back more towards the New Zealand or US dollar sort of stimulus level. But it is still the case that Australia has got probably as much stimulus as any major country. The vertical graph shows the monetary policy response, where the interest rates have been cut. The lucky thing about Australia, New Zealand, the US, Canada, and to a lesser extent the UK, was we had the ability to cut interest rates a bit. In the US, actually 150 odd basis points. But the problem in countries like Japan and the European Union was their interest rates were already at 0 or even negative, and so they had nowhere to move. So they haven't changed their interest rate policy because it was already at super low levels. So the only thing they can do is result in fiscal stimulus. But you can actually see the amount of fiscal stimulus is somewhere between 4 and 10% of GDP, which is huge. And this has all happened in 2 months. So the policy response has been large and very swift, and particularly in Australia and New Zealand, where we've got off pretty lightly relative to the US and Europe. So I think the likelihood of recovery in Australia and New Zealand should be very positive, which should also then flow on to many of our stocks. And we've done a bit of a summary. Now, we've amended this for people who are on our last webinar. We had a similar chart. We've now called it the good, the bad, and the ugly. And we've moved a few of these stocks around as we've got more information. But this really highlights for the 20 largest dividend payers our expectations of the dividend outlook. You can also think of this as the earnings outlook, because dividends tend to follow earnings. And we'll go into more depth in this, but we're very positive on the outlook for iron ore miners like Rio, BHP, and Fortescue. We think a lot of the sort of consumer staple stocks like Woolworths and Coles and Metcash, but Woolworths is only one in the top 20, is very positive. Telstra, whilst we've been negative on it in the last couple of years, we think in the medium term its outlook looks okay, given we're all working from home and using a lot of telecommuting. CSL, not really an income stock, but its outlook is pretty good. We think its dividends are underpinned, but it's a very low dividend payer. And ASX, interestingly, ASX saw volumes go up when we saw extreme volatility levels in March. Their volumes went up. I do actually expect their volumes will decline over the next 6 months, so it might be a sleeper there in terms of what happens to ASX. But I think their dividends are still pretty safe. In terms of those that will cut dividends, we believe Commonwealth Bank is probably the best placed amongst all the banks, but we probably expect a small cut there. It has the best capital position. We'll talk about the other banks a little later, but I mean, clearly Westpac and ANZ have deferred their decisions to pay dividends, and NAB cut it by 64%. Other stocks that we expect reasonable dividends from, but there may be the potential for some cuts, is Wesfarmers. Bunnings is doing pretty well. They've still got some holdings in Coles, which they're likely to sell soon. AGL, a utility, but clearly in this environment, if you've lost your job, you may not be able to pay your electricity or gas bills. And as we've seen, with a lot of people working from home, the volumes on toll roads, on roads in general, has fallen dramatically. So what we thought was a very safe utility, or like Transurban, has actually been impacted by this virus fairly significantly, although those numbers are coming back now as people are starting to go back to work. Other stocks that are in the more ugly camp is clearly energy prices have fallen significantly, and that will affect all the energy stocks like Woodside. The other financial institutions, whether it be banks or insurers or Macquarie Group, which is also a bank, have all been impacted, and we'll talk about the APRA directive, which came out in early April on the next slide, and even stocks like South32. Whilst the iron ore outlook is very strong, in other minerals it may not be as strong, although we do actually like some of the little gold miners, but they're obviously not in the top 20. But moving a bit onto the banks, I mean, the interesting development that happened only a week or so after our last webinar was APRA sent a letter to all Australian depository or banks, essentially, and insurers, those that are regulated by APRA, and regarding capital management, and it basically told them that they should significantly limit any capital distributions, or certainly, if you like, be very prudent in terms of dividends. Now, this closely followed some directives out of Europe and indeed New Zealand, where the relevant central banks or authorities actually pretty much told their banks not to pay dividends full stop for the rest of the year. So APRA has actually been a little less forthright. It's still allowing institutions to pay dividends, and we've seen a dividend paid or declared and soon to be paid by NAB. But they have told banks to be very prudent, and they have actually suggested they may consider deferring their decisions on dividends. And we've already seen 3 banks take the APRA up on that, because in addition to ANZ and Westpac, the Bank of Queensland also deferred its dividend decision. We would suggest, though, that banks may still want to pay dividends. In fact, we highlight here that APRA hasn't ruled them out completely. And in fact, it has suggested that if banks want to continue to pay dividends, or these institutions, they should consider using dividend reinvestment plans. And we have certainly been in the press encouraging banks to continue to pay some dividends as long as they offset them with those dividend reinvestment plans. But the reality is, in light of this, the expectations for dividends from banks are significantly lower than what they were a few months ago. As I mentioned, NAB's cut its dividend by 64%, but still paid one, or still paying one. On the other hand, ANZ and Westpac took APRA at their word and decided to defer their decisions. We've really, think that's almost like 100% cut, because there will be no dividend paid by ANZ or Westpac in early July, when they normally pay those dividends. So shareholders don't expect a dividend anytime soon. Perhaps ANZ and Westpac will reconsider this decision in August, or even later in the year when they report their full year results. We're hopeful then that they will be in a position to pay dividends. But clearly, this has reduced the dividends from the index, I mean, as a number from 2019, the big four banks alone represented 30%, 30% of all the dividends paid in the market. So if Commonwealth Bank follows the lead of ANZ and Westpac, then that will have a significant impact on dividends paid. But we don't think Commonwealth will. Commonwealth is in the best capitalised position of any of the major banks, a very strong capital ratio, and was actually talking about returning capital to investors. So we think is arguably best placed to pay a dividend when it reports in August, and hopefully the economics will be better. I will now turn over to Peter to talk about some other stocks.
Thanks, John. So we had this slide as well in the last presentation, and we thought we'd just update it because there's actually been some positive news from this. That these are the companies that have had previously announced dividends in the February and March reporting season, but then subsequently announced that they would either be deferring those dividends, so they'd usually pay them in March or April, and they were now deferring them until September, usually in most cases, or some of them even cancelled their dividends, like you can see Auckland Airport, Freight Centre, Harvey Norman, Super Retail, or WPP. But we've actually now seen NRW Holdings, which was one of the deferred dividends you can see, has actually now announced that they're paying their dividend on the 9th of June. And so that's an encouraging sign that a company that's got a bit more confidence in their outlook. So they initially kind of removed their guidance, but have now said that their guidance is the same place as it was before. They're a little mining contractor that serves a lot of the major companies in iron ore and other resources. Yeah, they're actually going to pay their dividends. So that's a kind of positive sign that companies might resume paying their dividends again. Moving on to the next slide. So this is just the announced dividend cuts that Don took you through, the largest 20 dividend payers. So I'll go over this quite quickly. But these are the ones that have already announced what they're doing in their dividends. So Don took you through the major banks. Macquarie cut their dividends 50%, which shows you the kind of diversification in Macquarie's business, that they didn't pay a dividend out of the bank part of their business, but they were still able to pay a dividend from the other parts of their business, like their funds management and trading businesses, things like that. IAG and Suncorp announced that they were unlikely to pay dividends in their upcoming August numbers, so they're ones to watch out for. Transurban announced that they would cut their dividend payments or distribution in June to the free cash flow that they generate during the first half of the year. So we wait to see how much that is, but that'll be a significant cut to their dividends. And Scentre Group, which I'll go through a bit later as well, has announced a 100% cut to its dividend upcoming in August as well. So some companies announcing well in advance that they won't be paying dividends. But moving on to some of the kind of good areas that we think still have a positive outlook. Yeah, Don mentioned the iron ore miners, Fortescue, Rio, and BHP. They're all trading on very large historical yields. Fortescue up at 17% historical yield. And if you actually look at the iron ore price on the right-hand side, you can see that it hasn't really moved from the last year ago. So China, and they recently announced that at their National Congress, that they were going to increase their spending on infrastructure through their local councils. And so that's actually caused the iron ore price to hold up quite well. Now, the steel production in China has stayed level over the last year, so they haven't reduced it at all, and it looks like it might actually increase in the coming months. But the steel production elsewhere in the world has dropped, but that's been largely offset because Brazil, which is having its own coronavirus problems, it looks like that's turning into the kind of latest hotspot around the world. And so they've actually, the iron ore production coming out of Brazil has actually been reducing. And so that's meant that the iron ore price has actually held up very well in the current environment, which we hope will allow the iron ore miners to continue to pay significant yields. And we expect them to going forward. We'll obviously monitor this if these kind of things change, but they're looking very positive right now. Another area of the market that is looking very positive is the Australian gold miners. You can actually see the gold price on the right-hand side has moved from kind of $1,800 an ounce a year ago up to $2,700 an ounce in the last year. Part of that's on kind of concerns around the global economy. Gold usually rallies in those environments. But it's also due to the immense amount of money printing that's going on by the US Fed in particular. The US Fed, I believe, has printed over $3 trillion of new money in the last couple of months. And so while kind of money can be printed, gold's the only way it can be printed is by being mined around the world, and that's obviously very low. And so that's actually caused the gold price to kind of rally significantly. And so that, we think, will allow, hopefully these gold miners will be willing to pay out more of their earnings as dividends. But you can see that some of them, we've highlighted Regis Resources, Santa Barbara, and Evolution Mining, actually have okay yields at the moment. So they're not kind of massive yields, not like the iron ore miners, but they're still pretty significant and they look very safe going forward. So we thought that was an area to highlight, that we've kind of moved overweight, even more overweight in our portfolio during this current crisis, because you actually saw the gold stocks fall as the crisis happened in early March, which was very strange. We thought it was just a matter of people in the market were just selling every asset they had. And so we're actually able to pick up some of these gold miners at very cheap prices, and then they've subsequently rallied, and we expect them to continue to do well. Another area of the market we think is positive is, we know the challenges that are happening to retail property trusts, such as centre or vicinity centres, but some of the other areas of property trusts are actually doing okay out of this. And so you see kind of Goodman Group, which actually have industrial property trust kind of assets. And so they actually run like a lot of the distribution centres for people like Amazon and others. And so they actually get a benefit by people switching to online because they actually own the distribution centres. So Goodman Group, it's on a pretty low yield, but one we actually think is even more positive is Goodman, just because it's a lower price, is Charter Hall, which does a similar kind of thing. It's not as exposed to it as Goodman, but it does a similar thing. It is announced already twice that it's confirming its guidance for this year. And so it doesn't look like it's overly affected by COVID. And it's already kind of reaffirmed that it's got 40% growth in its earnings over this year. So it's looking pretty positive. I mentioned it kind of already, but some of the dividend traps that we think investors really need to be careful looking at historical yields in order to evaluate whether stocks are going to pay those dividends going forward. As you can see, the historical 12-month yields on the right-hand side of Sydney Airport, which has announced it's not paying a distribution in June. Scentre Group, which has announced it's not paying a distribution in August, sorry. And Vicinity Centres hasn't announced yet, but we'd be surprised if they pay a distribution in June as well. But they're all sitting on very healthy historical yields, but going forward, we think those businesses are very challenged in the kind of COVID environment with social distancing continuing to go on. Even as the economy opens up, we still expect social distancing to challenge both travel and also travel in shopping centres. I'll pass back over to Don again to talk about the overall dividend outlook for the Australian market.
Yes, so we monitor the likelihood that stocks would be a dividend trap at the individual stock level. Now, this slide here aggregates that up. So we look at every stock that pays a dividend and we aggregate up the likelihood or the percentage chance that that stock may cut its dividend. And we've got that historically over time, going back for nearly 20 years now. You can see there was a spike in that, an increase in that probability of dividend cuts in the GFC, and it actually touched 40% in the middle of the GFC. And there's been a very rapid spike in the last 3 months. So it was at sort of normal levels, even if we started at sort of start of this year, but it has rapidly increased to over 40% or over 45% as we're sitting here now. Now, this I would highlight that this model is a guide only. It's not 100% accurate, because we actually look at what happened in the GFC, the market level. As we talked in the last webinar, that at the market level, dividends were cut just a bit under 30% during the global financial crisis in 2008-9. Whereas this model actually was predicting a 40% cut, which is substantially more than the 30-ish% cut that actually happened. So, but it is indicative that we are seeing a high chance of probability of dividend cut. Our forecast at the moment is still 30% for the market. We are hopeful that the banks will actually pay some of those deferred dividends in the future. but it is highlighting the extreme risks that we have now. What I would say is in the last week, even in the last week or two, we have seen the economic news become quite positive, and we have seen the environment open up. So hopefully that will start to turn down in the near future. But it does give us an idea of the likelihood of cuts. So when we take that into account and we take out and we look forward in terms of our income expectations, on slide 19 here, look, it's quite easy for us to provide the forecasts for things like overnight cash and 10-year bonds. They are actually the current yields. And the return over 12 months for a term deposit is the current term deposit rate, which according to the RBA is just under 1% at the moment, although I'm sure you can shop around and get a little bit better than that. But if you look at the dividend yields we expect on global equities and domestic equities, even despite the fact that markets have fallen a bit and now rebounded back again, we actually think the yields overall have fallen because of the likelihood of dividend cuts. So actually we got our MSCI World yield now staying roughly at its normal level of 2% despite the fall in markets, because we think the fall in markets increases yield, but the likelihood of dividend cuts globally of around 20 to 30% pulls that back to 2%. And domestically for both REITs and Australian equities, our expectation of market yield from today's or at the end of April, that the market on a 12-month basis would yield about 5%, and that's gross of franking in Australia. So that's down from the normal level, which is something more like 6%. So there are our forecasts. We still expect that we will comfortably exceed the income from the market by moving into stocks like the iron ore miners and those where we see some good opportunities for dividend. But clearly yields are lower than what we would have forecast at the start of this year. So summing up, we're probably over time, but volatility is still at elevated levels, even though it's declined from the very high levels of VIX we saw in mid-March. Clearly, the pandemic curve is flattening here in Australia and indeed in most of the developed world. But as Peter mentioned, areas like Brazil are still, haven't really controlled their virus. So there are certainly problems in some of the emerging markets. There is, of course, the potential for second waves. I think there's less likelihood in here in Australia, given we're very much on top of it. But I think in Europe and the US, as they open up their economies, there is more of a risk of a second wave of infections. And I believe in the Western world, recession is unavoidable. One thing we can be sure about is that interest rates are going to be even lower for longer. And that's impacting the income levels on all asset classes in the recessionary environment we're likely to have this year. Although hopefully we can pull out very strongly in a V-shaped recovery. As I mentioned, we expect dividends to be cut by around 30% across the market, but there are bright spots. So in the case for active management, we think has never been better. Whilst we may see deferrals of dividends from some of the big banks, etc., we expect some very strong dividends from the iron ore miners, but there will be some dividend traps out there. So look, that's probably enough from us. I'll hand back to Mark, and we might see if we can have some questions.
Well, thanks, Don. Pete, always great to get your views on income investing, especially in such a volatile time for Australian equities where dividend income is under threat. A couple of key takeouts from the presentation today is, I think there's never been a greater need or time for active fund management, especially in the high income space when you're managing portfolios for low tax investors such as retirees, and having a fund manager who is active, but also a fund manager who actively seeks to avoid those dividend traps, avoid that capital and income impairment. And importantly, unlike most income funds, Plato does have dual objectives. It is to deliver much higher income than the market, but also outperform the ASX 200 on a total return basis. Just want to remind everyone that. And importantly, Plato doesn't use any derivatives to boost income, which can also impair capital. And as Don mentioned, just a reminder, all attendees do have the opportunity to ask questions, and you can do that by clicking the questions tab on your screen. We have, as always, been inundated with questions. So I'll kick off with one on the banks, which is always a popular topic. Does Westpac not raising capital like NAB did put it in a weaker position to maintain its dividends going forward?
I'll take that, Mark. No, it doesn't. I mean, Westpac was in a stronger capital position than NAB in the first place, and by not paying any dividends, obviously it's preserved that capital. So NAB actually did pay some dividends, but it needed to raise capital whether it paid those dividends or not. And so the capital that NAB has raised was just catching up to put it in the same position as really ANZ and Westpac. But I would reiterate that CommBank is actually in an even stronger position than any of the other three, although they are all now in the APRA's unquestionably strong capital levels.
Excellent. Okay, just moving on to another sector. I see CSL is in your top holdings. What's your view on the outlook from CSL from an income and a growth perspective, and any views on the healthcare market overall?
Yeah, I can take this one if you like, Mike. So yeah, I mean, we're pretty kind of positive on CSL, but if the market continues to rally from here, then we don't necessarily expect CSL to participate in that rally. But if the market then falls, we also think CSL will hold up. So it's a pretty kind of low beta holding at the moment in our portfolio, but it's still a great business that isn't particularly affected by this COVID situation.
And Pete, any other healthcare stocks that you guys like?
So we like ResMed. It's kind of in a similar boat to CSL. It has had some tailwinds behind it, creating some of the ventilators for Australia and other governments. But but it also has kind of had some negatives in terms of people are less likely to go to hospital at the moment and undertake new surgeries and whatnot. So that's been a negative, but we generally like that business long term. Sonic Healthcare is another one that we like. Benefits from increased testing in this COVID environment as well. So there's a few.
Okay. Another sector actually. What's your view on energy stocks? Can they maintain dividends, or will they need to raise capital like they have done in stress periods in the past?
So the one energy business that was challenged definitely was Oil Search. It had way too much debt, and so it's already done its capital raising. The rest of the sector looks pretty much okay from a capital perspective. Santos is the one that's a little challenged that may have to raise equity, but they have been selling some of the stakes in their existing assets, so they might be okay. But we definitely don't see many dividends coming out of the energy sector in the upcoming period with oil prices as low as they are at the moment.
Okay. Just back on the banks, can you provide any update on the smaller banks and their ability to pay income?
I'll answer this one again. We still think the smaller banks are struggling in this kind of environment. If you look at their kind of competitive position versus the majors, as times get tough, that competitive position is only under more pressure. And so, we still think they're going to struggle.
And Don, I think you mentioned that Bank of Queensland deferred their dividend as well.
Yes, they did. Although, in their defence, Bank of Queensland actually made their announced their earnings and their dividends the day after or the morning after APRA sent out their letter. So Bank of Queensland had very little room to manoeuvre. So I think had virtually no option other than to defer their dividend. But as Pete said, the smaller banks, the regional banks, tend to have lesser capital positions, and so the big four are unquestionably strong, and I think that they'll eventually do well out of this. So obviously, we expect some bad debts in the short to medium term.
Okay, look, we do have time for one last question. As I said, we have been inundated, but we will get back to anyone who has asked a question. A bit of a controversial one here. Metcash, it's been a stock you guys haven't liked in the past and have put up in lights as a dividend trap. What's your view on it now?
There's a bit of old history there, Mark. It's over 5 years. What's 5 years ago that we were pushing or talking about Metcash as a dividend trap, and it didn't pay dividends for a couple of years, and share price got down to below $1. That stock's turned around. It's repaying dividends, and it's in some areas such as hardware and retailing or sort of wholesaling to retailers, that's actually pretty stable at the moment. So we actually quite like that business at the moment, and it's a lot better valuation than say Woolies, even though we do actually like Woolies as well. But no, our view at the moment is pretty positive on Metcash. I mean, I think got to learn about investment management is that you can't just sort of have a view about a stock and never change it. That you need to refresh that view, and if things turn around, then you welcome that stock back, and vice versa.
Yeah, the beauty of the strategy being targeted for low tax means you can be quite nimble. Okay, look, that is all we have time for today. I'd like to thank Don and Pete for their presentation. Plato, in terms of its investments, are available in a number of different formats. You can access Plato Australian Shares Income Fund either directly or via the platforms, which it has quite wide access. We also have a listed format, which is the ticker code PL8, and you'll also notice that Plato is available on M Funds. The funds are also favourably rated and reviewed by Lonsec and Zenith. We will be making the webinar today available on the Plato Investment website, and that's www.plato.com.au. We certainly like to thank everyone for their participation today. We certainly appreciate your engagement. We do get lots of questions, so if we didn't get to your question today, we will respond by email. If you do have any further inquiries, please refer to the Plato website or contact the Pinnacle distribution team members that you can see there on your page. We certainly thank you for your time today. We look forward to speaking with you at our next webinar. Or if anyone would like a one-on-one meeting with the Plato team, we'd certainly encourage you to reach out to the Pinnacle distribution team members and we can arrange that for you. So goodbye and have a nice day.